What's going on, guys? Hey, we are in the second to the last video here. The next one is just a conclusion and a kind of a wrap up of everything that we've talked about. But everything that we've been working on in this series of videos culminates here. And just having a basic a basic understanding of your balance sheet can help you manage things going forward. All right. So here's what we're going to talk about. In an earlier video, I mentioned that your balance sheet really equates to the financial health of your business, right? As opposed to performance. That's the income statement, and that'll be our next series. But the balance sheet is about financial health. Okay. So let's talk a little bit about it. I've got our balance sheet up. It's the Excel version of what's in our Blueprint for Balance booklet, but we have that up here. And the one thing that is really important to understand about the balance sheet and any financial statement for that matter is the trend is your friend. Okay. At least hopefully it is. Okay. Because if it's trending in the wrong direction, maybe it's not so much your friend. But we want to see the trends that are taking place. Okay. So as I'm just looking at this, here's what I'm gonna see or show you is like here, for example, cash, right? Cash is on its way up. Okay. That to me is a good sign. You know, month over month, we have an increase in cash. All right. Accounts receivable. That's a little bit tougher and it's circumstantial. Okay. So when we're looking at that, if we've got, let's say, flat sales and we've gotten a decrease in $3,000, that means you're speeding up collections. And that can go into another ratio called the day sales outstanding, which is one of the accounts receivable metrics that you can use. And I'm going to call it a inter-financial statement ratio, if you will. I've talked a lot about balance sheet ratios, but you've got to use a component from another financial statement to get to day sales outstanding. And we're not going over that. So anyway, up or down on receivables it's dependent, right? If you had an increase, you hopefully have an increase in sales that goes along with that increase in accounts receivable. If you're flatlining in sales and you have a decrease, that's definitely a good sign because it means that you've actually collected on maybe some old stuff, right? Inventory, that's another one that can be very, very dependent on things, on circumstances, right? It depends on sales. Maybe you're bulking up. Again, we talked a little bit about how financial statements, they tell you what happened, but it doesn't necessarily tell you why it happened. All right. So that's why it's not super easy to just go in and look. This is why it's so confusing for a lot of people too, is when they're looking at financial statements because, why'd that happen? Why'd this happen? And so it's so understandable that people struggle with financial statements. But again, what I'm going to say is that this is a skill like driving a car. This is a skill like reading or math that we were taught years ago in schools. But you know what? No one ever told us or taught us how to use financial statements to our benefit. All right. So anyway, getting back to this. So some of the current ratios or the current assets and the current liabilities, they're easier to diagnose. The more long-term ones, those are definitely easier to diagnose because, hey, if you had a change in assets, if it went up, that means you probably bought some fixed assets. Not probably, you did. But the one thing that you should always see is some depreciation, which is what we're seeing here. Month over month, we've got depreciation that is It's an increase in a negative number, so it's a decrease in your balance sheet. Okay. Now, getting back to some of the current assets, our payables went down. That is on the surface, it's a good thing because now you owe less to others. Okay. Same thing with credit cards. That went down. That means your spending was a little bit more conservative, and as a result, you're either that or you were aggressive in terms of payments. Again, back to what I said a minute ago. The financial statements tell you what happened, not necessarily why it happened. Okay. But both are extremely important. This is why it's so important to understand what's going on here, is that it gives you a basis for those questions, right? So nothing changed with our payroll liabilities, but you had an overall decline in current liabilities. To me, that's great news, okay? All right, on to the long-term liabilities, right? Here, these declines are as a result of, my assumption would be, without doing any digging, it would be due to really just routine payments. Nothing super complex there, right? Now, if we saw something like this, where we saw an increase, that means someone's borrowing money, right? And so that is something that we want to look at as well. And again, it's just a matter of understanding what happened. So on to equity. All right. Now, equity, this is usually very, very simple. We talked about this a few videos ago. There are really only 3 things. We'll say there's 4 things, okay? But one of them is it's still operational in nature, and I'll mention that one first. All right, it's going to be either a net income or a net loss, right? Or you've got distributions and contributions, right? So in this case, let's assume that there are no contributions and there are no distributions. This increase in retained earnings is going to be net income. Okay, it's net income. Now, if we want to assume that, so anyway, to kind of wrap up on the balance sheet side of it, because we're going to talk a little bit about ratios here in just a second. The trend is your friend. Understanding, the understanding that you need more than anything with respect to the balance sheet or any other financial statements is really, it's going to tell you what happened. Now it's on you to figure out why it happened. Now, let's go to the ratios for just a minute, right? So again, the trend is your friend, right? Current ratio, I want to make really clear that good strong liquidity, meaning that the higher your current and cash ratios are, the more flexibility you have in terms of operating, okay? If you are cash poor, all right, you see how the ratios went down, right? Your cash ratio went way down. It's 0.1. That means you've got to really tighten the belt. You don't have much flexibility to go out and buy anything. But with $20,000, that changes the picture a little bit, right? So again, all of this is on its way up. If we go, all of these are on their way up, so that's good. But if we, damn it. All right, you're gonna have to edit some of that craziness out, Chloe. I had done this. Okay. So understanding these ratios is really a critically important piece of things because it especially, all right. Let me start that over. We're just going to start the entire current ratio discussion over again, Chloe. All right. So getting back to our our liquidity ratios. Liquidity, good, strong liquidity is your friend, okay? And we're gonna change this balance sheet to provide you with a perfect example of this. If I have $3,000 in cash in my bank account, did you see what happened to everything? These numbers went down. All of them did. We actually have negative working capital. And what that means, that's a terrible place to be, because you have fewer current assets than you do current liabilities, meaning that you actually owe more than you own. Okay, so that's not a good place to be. So if I undo this, you can see how much stronger a position that we have. And if this goes up even more, we get to an even stronger position, right? I like this because I know I can pay in just out of cash. I can pay all of my current liabilities and still have cash left over. That's a wonderful place to be, and that is flexibility. That equates to flexibility, all right? So anyway, let's go back to the original numbers for a minute. And then when it comes to the leverage ratios, if you're looking to get a loan, and this is where planning takes place, right? What are some of the things that you want to do with your business, right? Let's think about what those are. Do you want to buy a fixed asset? Do you want to get a term loan so that you can hire other people to scale your business up, to do something bigger? Well, if you're in that place, remember we talked about on, I believe it was our last video, lenders want to see that you've got some skin in the game. So if you've got 40%, that's probably not a real good place to be. But let's move some numbers around. Let's say that we have zero debt, zero liabilities, and let's see, and we have more equity. All right, so we've got $60,000. Whoops, not that. That's not right. We want that to be 40. There we go. Now we balance again. Okay. Now, did you see what happened with our ratios? The ratios changed, right? We were here where we had a 60-40 split, and then we went to where we had 65% equity. Now, this is a balance sheet that most lenders are going to look at and be pretty pleased with. They're going to say, okay, you've got equity in the business, you've got a current ratio and a cash ratio that's pretty strong. We would probably be willing to look at that as a lending opportunity. Okay. Now we're only looking at the balance sheet. There may be problems on the income statement. We haven't gotten that far yet, right? But these are the sorts of things that you can plan for, right? So if you're wanting to take out a loan, this is where managing your balance sheet comes into play, right? Start paying off those loans. Bring down your credit card balance. Bring down your AP. Start building up cash where you can. Really get aggressive with collections for people that owe you. Those are just some things that you can do to plan for getting that loan. Okay. So I hope that was educational. Trends are your friend. Plan for the future. And that's it. That's it. So if you have questions, put them in the comments. If there's something that you want me to talk about in the future, let me know in the comments as well. And finally, like our page, like our business page. Thanks so much. We'll talk to y'all soon.